Hi, Greg Dorsey here. It's Monday, January 14 at Leeb's Market Forecast. Well, last week I offered a rather cautious view of the stock market in the year ahead based on current valuations, expected earnings growth, and the length of time since we last experienced a 10% or more correction. This week, I'm pleased to offer a more optimistic view, one that's based simply on the market's action in the early going of 2013. There's an old saw on Wall Street that says the first week of trading sets the tone for the rest of the year. But it turns out it's not that straightforward. Yes, there have been numerous occasions where stocks were up in the beginning of the year and remained strong throughout the rest of the year. And there have been times when losses early on foreshadowed down years come the end of December. But as a predictive tool for the remainder of the year, the action in the first week of the year in and of itself has frankly not been statistically significant. Excuse me. However, there are times when it does pay to heed the message of the market. Specifically, I looked at the performance of the S&P 500 in the first 4 trading days going back to 1928, which is the earliest I have data. And what stood out was when the market climbed by 2% or more, as it did this year, stocks overwhelmingly tended to advance for the rest of the year. In those 84 years, there have been 18 in which stocks gained at least 2%. In all but 2 of those, stocks not only advanced for the rest of the year, they also turned in above average gains, tacking on an additional 11.2% on average, excluding dividends. The exceptions occurred in 1931 and 1987. In 31, the Great Depression was at its height, and investors experienced a disastrous year. Stocks were down some 49%. Excluding that 31, that average of 11.2% jumps to a return of 14.8%, again excluding dividends. We had a stock market crash in 87 too, although if you include the first few days of trading of the year was still positive for stocks. The economy is in no great shakes right now, but it's a far cry from 1931. So 2013 could be another good year for equity investors. I'm not trying to saddle the fence here and have it both ways, offering a dour outlook on one hand, as I did last week, and a more positive one on the other. There's certainly no lack of risks in this market. But with an 89% accuracy rating, this is an indicator that's worthy of your attention. Thanks for stopping by. We'll see you again soon.